Most people think wealth is built in a single defining moment. A big promotion, a lucky investment, a viral idea that changes everything overnight. But the truth is far less dramatic and far more powerful. The people who end up truly wealthy almost never got there through one massive leap. They got there through small, quiet habits that repeated themselves day after day, year after year, until the results became impossible to ignore. Nobody talks about these habits because they are not exciting. They do not make headlines, but they compound, and that compounding is where the real magic lies.
Fear spread in the month of September 2008 at a rate that was like a tsunami.
Warren Buffett did not become the world's most celebrated investor by chasing hot stocks. He built his fortune by reading 500 pages a day, thinking long-term, and letting time do the heavy lifting. His first investment was at age 11. By the time most people start thinking about retirement savings, Buffett already had decades of compounding working in his favor. That is not luck. That is the quiet power of starting early and staying consistent. The habits nobody sees coming. The first financial habit that compounds quietly is paying yourself first. Before bills, before groceries, before entertainment, a fixed portion of every paycheck goes directly into savings or investments. This single habit sounds deceptively simple, but it rewires an entire relationship with money. Instead of saving whatever is left at the end of the month, there is nothing left to spend carelessly because the important portion is already gone. Rahana.
First of all, I would like to say you are glowing, and I can't tell, is it Fenty or is it the fact that you just had an amazing fashion show?
It's both, actually. I have had an incredible evening. I've had the most incredible supporters.
Who built her Fenty beauty empire into a billion-dollar brand, has spoken openly about the importance of financial discipline behind the scenes. The glam and glamour are visible. The budgeting, the reinvestment, and the long-term financial thinking are not. But those invisible habits are what turned a music career into generational wealth. The second quiet habit is automating finances. When humans manually decide to save, emotions get involved. A hard week, a tempting sale, a spontaneous dinner, and suddenly that savings plan is delayed by one more month. Automation removes emotion from the equation entirely. Direct debits, auto-invest features, and scheduled transfers happen whether someone feels motivated or not. Over 10 years, the person who automates saves dramatically more than the person who relies on willpower alone. The third habit is tracking spending without obsessing over it. There is a difference between being aware of money and being anxious about it. High-performing earners tend to review their finances regularly, not to punish themselves, but to stay informed. Knowing exactly where money goes creates clarity, and clarity creates better decisions. It is not about cutting out every coffee or skipping every vacation. It is about knowing the difference between intentional spending and mindless leaking.
There have been plenty of successful stand-up comedians, but few who've managed to do what Kevin Hart has. In addition to becoming a bankable movie star, he's also built an entertainment and business empire.
Kevin Hart, despite his enormous fame and income, has spoken candidly about growing up poor and developing a fear of losing everything. That early anxiety turned into disciplined financial awareness. He does not spend based on feeling. He spends based on planning, and that shift from reactive to intentional is one of the most underrated financial habits anyone can develop. The invisible architecture of long-term wealth. Compound interest is taught in schools, but very few people truly feel it until it is already working for them. At the start, the numbers are unimpressive. Investing $200 a month at a 7% annual return barely feels worth it in year 1. But by year 20, that same habit is worth well over $100,000 without adding a single extra dollar. The habit did not change. Time changed everything. This is exactly how Ronald Read, a Vermont janitor and gas station attendant, died in 2014 with a net worth of $8 million. He bought stocks in companies he understood, never sold, and let time do what time does best. He drove an old car, lived modestly, and compounded quietly for decades. No one knew. That was the point. The habit of investing in index funds is another compounding powerhouse that operates below the surface. Rather than picking individual stocks and hoping for brilliance, index fund investors buy the entire market. They accept average returns, and average returns, compounded over 30 to 40 years, turn ordinary earners into wealthy retirees. The late Jack Bogle, founder of Vanguard.
Let's talk about international, and you and I always talk about this. You're kind of a contrarian even within your firm in terms of thinking that investors don't necessarily need international stocks to have a globally.
Championed this strategy for decades. Millions of people are now financially comfortable because they followed a habit that required almost no effort after the initial setup. Avoiding lifestyle inflation is perhaps the most quietly powerful habit of all. When incomes rise, most people raise their spending to match. New car, bigger apartment, more subscriptions, more dining out. The income grows, but the gap between earning and saving stays identical. The wealthy do the opposite. When their income increases, they increase their investment contributions first and adjust their lifestyle second, or not at all. Dolly Parton, a woman who grew up in genuine poverty in rural Tennessee, is famously frugal despite decades of massive earnings. She invests in her businesses, in her community, and in assets that grow. She does not perform wealth, she builds it. The mindset shift that changes everything. Behind every financial habit is a mindset, and the mindset that produces long-term wealth is deceptively quiet too. It is the mindset of delayed gratification, the ability to say no to something good today in order to say yes to something great tomorrow. In the famous Stanford marshmallow experiment, children who waited for a second marshmallow instead of eating the first immediately went on to demonstrate better outcomes across multiple life areas, including financial ones. The ability to wait is not just a personality trait, it is a trainable skill. And every time someone chooses to invest instead of impulse buy, they are training that exact muscle. Jay-Z built his wealth not just through music, but through a series of patient, strategic moves, buying equity in companies, investing in real estate, launching businesses, and waiting for the right moment to scale or sell. His net worth crossed $1 billion not because of album sales, but because of compound decisions made over 2 decades. He understood that money is not meant to be spent, It is meant to be deployed. Another mindset habit that compounds quietly is learning about money consistently. Reading one book about personal finance per quarter, following credible financial thinkers, understanding how taxes work, and knowing the difference between an asset and a liability. These are small intellectual investments that pay enormous practical dividends. Most people spend more time researching a television purchase than they spend understanding how their retirement account actually works. They are just consistent, and consistency, above everything else, is the most powerful financial force that has ever existed.